Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors, and welcome back to Real Estate Investing Abundance. I'm your host, Dr. Alan, and I am delighted to have with us today a good friend of mine, Matt Hansen, and he is a venture capital investing individual who says that is venture capital investing better than real estate? And we're going to have an answer to that question today. So Matt is a retired corporate executive who transitioned to full-time real estate investor. His investment portfolio includes over 2,000 units of multifamily apartments and many other alternative asset classes. So Matt, take us into the show and share a memorable experience that helped you to be who you are today.
Well, thanks. Well, thanks for having me on the show, Alan. You're one of my favorite people, so this is going to be fun.
You're one of my favorite people, so I'm glad to have you with us today.
Thank you. I would say probably I grew up in a drugstore, oddly enough. Our family my dad was a pharmacist, so I literally, after school in the kindergarten, I'd walk from the grade school to the drugstore, and I would sweep the floors, wash the windows, and do all that stuff. So I think that alone just and there's 5 kids in our family. So we'd run the store, we'd run the business. At that age, at 7 years old, I had a job and a paycheck and everything else, but I worked. That was just incredible. The work ethic, all of that stuff was instilled at a young age, and I didn't even know it until I got off into college and realized, oh, you guys didn't all have that experience. You don't know how to deal with the public and how to work your butt off for the family, work on the weekends. So I think that's really what's made me, and I credit pretty much all my success to my parents and raising me that way. Though looking back, I had to work a lot, but boy, it's just really made my life wonderful. The fact that I had all those skills at a young age, and it really made it easier in the corporate world because I already knew what to do. So I think that's my biggest thing.
Yeah, I talk to a lot of people, and a lot of them credit those early work experiences, particularly those who were fortunate enough to grow up in an entrepreneurial family. So I'm curious. Your dad was a pharmacist. Why didn't you follow into that trade? I mean, it's lucrative. It's a helping profession. It seems like it would fit you perfectly. Why didn't you do that?
By the time I got to college, I was like, no, I don't want to work in a drugstore. My whole life I did that. I do have nieces and nephews. My grandfather was there's tons of pharmacists, probably 6 or 7 in my family. None of them took over the business. My brother was a CPA, and he actually took over the business, and he hired one. But it was just one of those things that, because I was exposed to it and I worked in it my whole life, and that was another thing. Growing up, I worked 6 days a week. I never had a weekend off. So my goal was, when I get into college, I'm going to get a job that I don't have to work on the weekends. So I would just work 5 days a week. And then of course I'd work 60 hours a week. But so that was my learning. It was like, because I worked in a drugstore, I didn't want to do it anymore. That's the answer to the question. It was overexposure. I saw how tough that job was.
Yeah. Well, yeah. Running a business is no piece of cake for sure. So how did you transition from the corporate executive world to real estate investing?
Well, I started because of my job level, I wasn't allowed to do anything openly. I worked for a vice president. Said, don't tell anybody you're doing this. So I did it behind the scenes. I've been doing real estate investing with my wife for 30 years. We used to flip houses like literally 30 years ago. We did this stuff. So, and we stopped as our kids grew up, we stopped doing that. And then I got back into it probably 8 years ago. And that's when I got into this buying large multifamily assets and things like that. So for about 6 years, when I had my corporate gig, I would do the behind the scenes of, finding the deal, doing all the paperwork from putting in the offering to closing the deal. I would herd all the cats, if you will,
Mm-hmm.
the lender, the broker, the insurance company, the legal and all that stuff. And then, so I've been doing this for quite a while. Then 2 years ago, when I retired, I could openly tell people I was doing this. I'm not just the behind the scenes guy. So it
Mm-hmm.
really prepped me well. I was able to do that because my
Mm-hmm.
job allowed it. I'd spent more time on real estate. I can say this now because I'm retired. I would spend more hours on real estate than in my day job at that point. So that's kind of how my transition was. I prepared pretty well so I could retire early behind the scenes. So then, when it was time, I could openly say, hey, you know what? I have a real estate investment firm, by the way. But people were surprised that I'd been doing it for so long because I kept it a secret. So that was my transition was pretty, it was years. It was like 5 years. So it wasn't a simple, quick thing.
Well, I think that's good information for people to know. A lot of people think that, well, I can just quit my 9 to 5 job and jump right into real estate investing.
No.
I've not encountered anybody who has been successful in attempting to do that. So thank you for sharing that. So how does someone get started in passive investing? You started as an active investor, actually. And a lot of people think that that's the only way to invest in real estate. So tell us how we can keep our 9 to 5 and keep our security blanket on and passively invest in real estate.
So I did the active stuff with single family homes, the fix and flips and all that. We did that. But then when I started to do these larger syndication, apartment, group funding type things, I did passive invest in quite a few deals to begin with, like 3 deals, though I'm an active investor. But from when it came to the large multifamily, the $40 million deals, I passively invested. So I did get a lot of good experience, probably in 3 or 4 investments before I decided that I'm going to go off and do it on my own. I wanted to get that experience. And from as an investor on that end, you really understand, okay, how did that general partner, the person I'm investing with, how did they treat me? Did they give me, routine updates? Were they transparent? Was the follow-up really good? If I had questions, did they answer them? So I learned a lot of things, what I shouldn't do when I had my own investment firm. And so that's the way I treat my investors, that, okay, what information do I want? I want to have, all the data I need to make an educated decision. You want to check the track record. And I did have one investment that went kind of sideways that I invested with. And it was kind of my fault. I didn't vet all the partners. I only vetted the one partner, but there was 3 or 4 partners. And that one partner actually ended up leaving the deal after a year or 2. And the other partners weren't as strong as him. So that's one of those lessons learned. Make sure you vet whoever you're investing with, vet all of the individuals, and make sure you have all the data to make a decision. It's ultimately your decision. So I think that's the big key thing, is the data and vetting individuals. You're not investing in a company or not even in the deal. It's the people you're investing in. That's my big tip.
Yeah. Well, I keep hearing that from all of the investors that I talk to on my show, and then all of those that I network with, that it really is the team that you're investing in. And I don't know that anyone had really pointed out the fact that, I guess, one link in the chain can make a significant difference there. And so it isn't just checking out perhaps the lead sponsor on that, but checking out everybody in that whole chain there. Good advice there. So what, besides checking out the sponsors in these deals, what are some of the other things that we should look for?
Of course, the market. Real estate is still location, location, location. Is it in a location that has got strong employment growth, population growth? You do want the laws to be neutral, or at least favorable to landlords. California's kind of a tough market. I know friends that own into California, but it's really hard. If somebody doesn't pay your rent, it's very difficult to evict them, even when you're justified for. So we typically invest in Texas, Florida, Arizona. I've got some stuff in Tennessee, I guess in North Carolina. I guess I've got stuff in a lot of states, but they're typically landlord friendly. That's important. And you do really want to make sure, as an investor, I actually do the Googling. I'll actually look at the numbers, and I'll make sure, okay, is this a good market? Is, in any larger metropolitan area is pretty good. But what you'll find is people will, I'll get deals pitched in a town of 20,000 people. Nothing wrong with that. But that, as an investor at 20,000, there's one or two probably primary industries or employers. If something happens with that industry or that employer, that apartment complex occupancy is going to plummet.
Mm-hmm.
So that's one of those things you've got to do a little your own due diligence on the market, the property itself. Everything's Googleable today. So Google it. And I'm not talking about hours and hours, just an hour worth of time of saying, hey, is this really a good market? Even a sub-market is in Atlanta. Well, what part of Atlanta is it in? You can find that stuff yourself. So I would say, you always want to trust people, but you need to verify. And I think that's really important. And stuff you can do yourself. It's not that difficult.
Well, in terms of the documents that a passive investor needs to be familiar with and to look at in terms of going into a real estate investment, start off with the private placement memorandum. And that sounds like a really, really scary term, but just break that down because it's a critical part of the investment.
So that's really the agreement that you authorize to say, yep, I'm going to invest in this specific apartment complex, or it could be even a fund, a real estate fund. So think of it as like if you're investing in Wall Street, you get that prospectus. Has anybody ever read a prospectus on a new investment that they're doing or mutual fund? Nobody reads those because they're 300 pages long. Well, that's what this is. These are usually about 100 pages, and it tells you of all the potential things that could go wrong, just like that prospectus is that you didn't read. It really just tells you, the roles of the shareholders, what your position is on it. You're a limited partner. A limited partner means it's good. It means you're limited liability. So if something should happen, if somebody's, being sued for slip and fall, they can't come after you. They're coming after the business. So that's the benefit of having, this passive investor. You get all the benefits with, the tax benefits, the cash flow, and the payoff at the end without being on the hook for, something happens with a property and things like that. The property's insured too. What other investment do you have that's physically insured? We own properties in Florida. We were fortunate the hurricane didn't get us, but if it did, you know what? If we have to move people out, we have insurance that covers the missed rent, lost rent and occupancy. If the roof gets pulled off, we have insurance to cover the roof and the loss of income during that. What other investment does Wall Street offer you anything like that? Now, again, that doesn't mean that everything's, hunky-dory all the time, but versus, I'm buying a stock and I didn't even read the prospectus, or a mutual fund that's invested in 15 different companies. Nobody looks at those. That's what a PPM is. As my lawyer says, it's all the ways you could potentially lose your money. So you're clearly aware that's the same thing the prospectus says. So think of it in those terms.
Yeah. Okay. Well, how about an operating agreement?
An operating agreement just really tells, I'm going to try to lower my hand. It really tells you how is the property going to be run? And if something goes sideways, what are the contingency plans? And what are your rights in all of that? So that's part of the operating plan as well.
And the third one is the subscription agreement. What is that all about?
And that's finally, how are you going to invest? Because you can invest just as Alan, or you can invest in just as Matt, or it could be my entity is Hanson Holdings. I would invest in an entity, and it depends. Or if you have a solo 401k or a self-directed IRA, which is one of the most powerful tools out there that Wall Street doesn't want you to know about. They only want you to invest in stocks and bonds and all that, mutual funds. Well, with a self-directed IRA, if you have a past employer, you can roll those funds over to something that you can control, so you can passively invest in real estate. Again, Fidelity, Vanguard, all those big companies don't allow you to do it, but that's why you want to take control of your money. And you can Google that. Self-directed IRA is really powerful. So for example, if I invest with my self-directed IRA all the time, and it's called Matt Hanson Solo 401k, and that's the entity that actually is invested versus my personal name. Now there's maybe tax reasons you're doing that. A lot of people, my mom invests, she has a trust. So she invests with her trust is the entity that invests in that deal, and everything kind of flows through that. So that's really important. You need to know before you decide you're going to invest. Is it in my personal name, or is it in my company name, or is it in a trust, or is it in a, another entity, a solo 401k or self-directed IRA? So lots of options there. And that's something like Alan or I would walk you through. That's part of our thing, is to coach you on, okay, how do you want to invest? Because it's important. There could be tax implications. Yeah. And if somebody wants to inherit it, it's great to be in a trust. So stuff like that.
Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. Yeah, I think it's important for passive investors to be aware of these. I mean, these 3 documents, you should find those in any certainly in any syndication you're going into. If it's a partnership arrangement, you may not have those 3 documents, but a syndication you will, and you just need to know what they are. It's not like you need to know them backwards and forwards, but you need to know what they are. And certainly if you're a new investor and these are your first investors, I certainly would recommend that your attorney reviews those documents before you put your name to those. So you've been doing this for a long time, but specifically as a passive investor, I think you said about 6 years. Is that correct?
Yeah, 6 or 7 years.
About 6 or 7 years. Okay. So what are some of the key lessons, the key takeaways as a passive investor that you have learned over these 6 or 7 years?
Yeah, I touched on the one is to really vet the person. And that's why it's important to, take a look at their website, take a look at their LinkedIn profile, their Facebook profile. I mean, it's kind of like you really want to know who they are and kind of what they stand for, because that's the person that's going to be you're trusting your money to. And then, and I even say, and you'll hear this, I mean, that's even more important than the deal, because if it's a solid deal or investment opportunity, if that person's good, it's going to do well. But if that person's not really strong, they could make a good deal bad. That's the old phrase they say. So it's really important that, you invest in that individual first, make sure you understand what their background is, what their experience is, what's their track record. It's really important. That's, as Wall Street will say, that's the best predictor of future results, past results, but they can't guarantee them. They always throw the disclaimer, and we do too. You can't guarantee it. And then really looking at the deal, the location, the numbers, does it make sense? Particularly the projections. Everything we're doing is just like a prospectus from Wall Street. It's like, here's what we think that's going to happen in the future. We do the same thing here, but we're using data. We're saying, what is the rent growth in this specific market? What is the population growth? So the data's out there, the projections. So all these decisions for returns are based on projections. So you do want to take a little time, and there's usually always, you'll see some slides in the investor deck that says, here's the projections. So if they're saying that I'm going to have a 50% rent growth year over year, well, that doesn't look realistic. It should be like 3 or 4%. So there's things like that, just even common sense. After you look at a couple of those, you'll be accustomed to them. To look at the data, again, it's all provided to you. It's important that you have some basic understanding. You don't need to understand what a cap rate and a diversion rate and all these. You don't need to know those, but you need to know, does it pass the gut test? Do I feel good about this? Do these numbers look reasonable? I had an offering that got sent to me the other day because I'm pitched all the time, and I looked at it and thought, there is no way that is realistic. The numbers were so outrageous. Maybe they were legit, but my knowledge, and I know enough to say that, you know what, I don't think I'm going to touch that one. And I don't think it doesn't look right. So use your gut, and it usually tells you that. And again, after you've looked at 3 or 4 deals, you have a pretty good sense for that. Those are my things, that don't take everything at face value. You do need to challenge things. There's nothing wrong with that. If somebody gets defensive, if you challenge them, don't invest with them. I happily answer any questions you ask me because I know I was in that position once before and I really wanted to know. Mm-hmm. So again, if somebody's not willing to share the details or explain things to you, go the other direction, because they should be willing to do that for you.
Yeah, I would just add one more thing, and that is, has the sponsor stress tested the offering? In other words, have they looked at the possibility of another 2008? Have they looked at the possibility of another pandemic? and what's going to happen to the investment if that occurs, because we're looking at the future. And like Yogi Berra said, the prediction is very, very difficult, particularly when you're looking at the future. So,
That's so good. You got to think about that one.
Yeah. So, did they stress test it? And is the deal good enough to be able to make it through those downturns? Is always something to look at. And if not, it better be a very, very good deal. So tell us, Matt, about your company and how it is that we can partner with you.
Sure. It's Hanson Holdings, and Alan will have it in the show notes, hansonholdings.com. And we're, a multifamily apartment investment firm, and we primarily purchase in the South, Southwest, and those areas. Kind of the term value add, I don't like to use it. It's basically they're fixer uppers, but they're not really, really low level. There's A, B, and C, and they're like, C plus B things that are fixer uppers. That's what we usually do. You usually have the most value in that. It's something that usually hasn't been managed really well, or the tenants or residents weren't taken care of. And that's really so important. Those people pay your bill. They're paying you good money. We need to provide them a safe, clean, pleasant environment. And that's really what our goal is, to help the investors, but also help the residents. After all, you got to help people in the world. You want to be doing the right thing. And that's really what our focus is finding properties that need some help and matching them up with investors that say, yep, this is something I'm interested in doing. And these are long-term investments, 5-6 year type things. That's what we do for people.
Well, a lot of people in the professions have their retirement accounts, and most of them have their money in the stock market or in bonds. Why should they not just be satisfied with that?
It's diversification. I've got probably maybe 15% of my portfolio left in the stock market. And a lot of that stuff is captive. I can't even pull it out. I just think again, Wall Street is the enemy. I'm going to say that from my perspective. It is so manipulated. I'm going to get on my platform here. And I think statistics show that the actual value of a company versus its true value, I mean, the paper value, it's all inflated because of social media and everything else. 15 years ago, you could say the balance sheet is this is what the company's worth. Now you see the balance sheet is this, the company's valued as this because that's what the market will bear because they're really good marketers, or there's some perception. Elon posted or whatever. It's just so manipulated now with special interest and all that. When you get out of that realm and I do a lot of venture capital investing with small startup firms or other things like that aren't manipulated. I know who those owners are. They're my friends. I do know the market really well. I do understand these things. When I'm investing in Wall Street, I have no access, no ability to know what's going on. Things can be manipulated by the corporations and by the lobbyists and by the government. All of those things are going on. So I'm thinking, get some of your money out of Wall Street, just a little bit of it. Because I lost 300,000 in 2008 and 9 when the market collapsed, and I had everything in there. I mean, I did have some little bit of real estate holdings outside of that, but now I've just totally repositioned it. But again, takes knowledge. I'm comfortable in doing venture capital investments. I understand the risk involved, but the rewards are phenomenal in some of those things. I'm a part owner in a vineyard, road construction company, a company that builds apartment buildings in modular units. We've already pre-sold that whole manufacturing facility to a large builder. Gold mine royalties, land entitlements, new developments. I mean, all those different things, even within real estate, I'm diversified, and then I'm diversified outside of that. So I just say, you need to be sophisticated. You need to learn these things, but just relying on the stock market, particularly if you're near retirement age, that is not a good move. You need to pull something out to have something that's diversified, that isn't totally controlled and manipulated. So there's my Matt's world on the investment world. My view on the investment world is that you need to be educated and you need to diversify some.
And I think most people who have taken that step, even if they take a small step, they go, wow, there's something to this. And then almost inevitably, they do what you have done, and they end up taking all of it out of the stock market, or nearly all of it. So Matt, let's go back to what we started off with here in terms of your one of your investments where you did not investigate the entire team. And tell us about that. And other than the fact that you learned to vet the whole entire team, how did you come through that? How did you salvage that event?
Well, it was a large multi-family deal. I won't give too many specifics. I want to throw anybody under the bus. But what happened is that there was a change in the core team that managed it. And again, my friend was the lead, and he stepped away, and the other players weren't strong enough. So they weren't minding the store, if you will.
Mm-hmm.
The property management company was not doing a good job, and the asset management team that's supposed to be watching them wasn't on a weekly basis. They should be talking to them. Well, they weren't having those conversations. And then after a month or two, we saw our occupancy was going down because nobody was watching the property management company to hold them accountable for why is this? Well, they had some change of employees and stuff like that. Well, that's not an excuse. You need to make sure that our asset is running. We're paying you a significant amount of money. And that was the root cause of it. It was just not minding the store.
Mm-hmm.
Now, that was the year 2 into a 4-year investment. By the 4th year rolled around, it's making tons of money. Everything's good. I end up making 60,000 on it, but I should have made 100. So the opportunity cost was, I calculate, probably about 40 grand, but I still made money on it. Again, this is an extreme deal. And they even had a capital call, and I opted not to give them any more. They wanted another 12K. I had 100,000, I think, invest in that. They wanted another 12,000 as a capital call. I said, nope, you can dilute my shares. Just go ahead and take the holdings from another investor or private equity firm, which is fine. I didn't want to put any more money into that. And had I done that, I would have gotten, more money back. But at that point, I felt, you know what? I don't want to put any more money in that. I'll let it ride out. Turned out okay. So, I mean, that's a good ending to a story. But the lesson was, if I've really done my homework like I do now, all my venture capital investments, I personally know all the people I'm investing with. And I've known them for years, typically. And that's the thing about listening to things like Alan's podcast here, is you're learning about all these other experts and all these other industries, so you can start following those individuals. If it's oil and gas or ATMs or whatever, find the local expert on that, get educated, consume some of their content, and then you will be comfortable in cutting those strings to Wall Street 100%, relying on them. But it really only through education. That's why I love Alan's show. He has a diverse audience or guests on here, so the audience gets to learn these are other opportunities I didn't know was even available to me. So I think that's really important, to be educated.
Well, share with us 3 good experiences you've had in the last 24 hours.
Last 24 hours. Let me think. I'm interviewing people I also work for another company that helps people raise capital. I'm interviewing for jobs, and I just met a young gentleman that's actually in another country that was so impressive and just so self-aware and just really positive. You know how you vibe with people, and Alan and I have talked about this. We're both a little woo-woo on that. you get that vibe. I just really vibed really well with him. Hopefully it pans out really well. So I think that was a positive experience. Anytime you meet somebody and within a few seconds you realize, yeah, I get this person. They get me. They get, what's going on in the world. They're kind of self-aware. So I think that was a really positive experience. Another one, we're having some friends coming over this weekend, so we're getting the hot tub ready and setting some things up out there for a little party this weekend. There's another positive experience. And what else? Oh, my mom's moved into assisted living home, but the caregivers there are phenomenal. So I got to visit them, gave them a big hug the other day for how great they're taking care of my mom. So those are 3 things that went well and fortunate for.
Well, how are you putting your success as an investor and entrepreneur to work to create universal well-being?
I think really it's a disservice if you don't share knowledge like this, like Alan is sharing in his guest. It's a disservice if you know something that could help somebody else not to share that. Like this passive investing in real estate, I think it's not right for everyone. But if it is, it's a wonderful way for you to diversify your income, protect really, it's cash preservation right now for a lot of us. And to think about your family. I mean, this makes a world of difference in some families, is to have, I'm going to have long-term income. You're investing with a trust. I mean, I have investors that are in their 80s. They know the property may sell, after they're gone, but that money is going to go to their family and to take care of them. So I think that's the thing that I love about this, is helping people, particularly if there's some people that make a lot of money, but they don't keep a lot of money because it goes to taxes or it goes to this or that. I really like the fact is that we're not only helping those individuals, but we're also helping the people that are residents in our properties, that we're making it a better living experience. We make sure kids have a safe place to come after school and those types of things. So it's twofold. I like helping the investors, but I even like helping the residents even more, because those are the people you have a big impact on. They're taking their hard-earned money and paying us for rent. Well, we need to make sure they're taken care of when they're staying at our places. So I think that's really important. I think that's a service to the world, I hope.
Okay. Well, imagine you've come to the end of your life, and as you look back on your life, what do you look back on with your greatest sense of joy and fulfillment?
I would say my kids, probably. Just, you give me verklempt here. What are you, Barbara Walters? Just the fact that they've come up being loved with the abundance mentality and to be able to do anything they want in the world. My son lives in Thailand. He's a starving musician and music producer in Thailand. Loves his life. My daughter was in healthcare. She's helping people. So I think that's really important, that I raise two individuals that are helping the world be a better place.
Well, wonderful. Thank you so much, Matt, for being with us today. It's been a pleasure. And Enlightened Investors, thank you for being with us again today. And please like, share, and subscribe, and leave us a comment. Love to hear from you. Take a moment, please, and go to Apple Podcasts and leave us a rating and review. Until then, live abundantly, and we'll see you in the next episode. Enlightened Investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.